You're watching Stock Watch this week. I'm Ntauleng Lechela, and joining me to unpack your stock-related questions today, Andrew Padoa from Sasfin Wealth and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Gents, thanks so much for joining me today. Now, really a busy week, both here at home and on the international front. Here at home, we were dealing with a budget postponement, and internationally, we had peace talks, Fed minutes, as well as, more tariff threats and earnings also coming through. Andrew, let me start with you. What have you made of, trade so far this week?
So it's been quite volatile, and I think that's probably what we're going to see for 2025. If we look at offshore markets, 2023, 2024 were fantastic. 20% growth in dollars in the US for both years. I think going forward, returns are going to be lower and it's going to be a lot choppier. Markets are never certain, but just given, what you've just discussed that's happened this week, markets are just more, it just feels more uncertain than it has been for a long time. So I just think we just need to embrace volatility and just expect lower returns from markets in 2025.
And your assessment, Shane, would you say that the budget delay weighed on local markets and the rand, or we were just caught up in what was playing out globally? Because when you look at the rand now, when you look at the JSE at the moment, it seems quite stable.
So, Zanati, I guess most people are taking the delay in the budget as being a sign of a maturing democracy. So I guess for the moment, the glass is half full. When the budget delay was initially announced, there was some panic. The rand blew out to about 1860, and it's now retraced to 1835. So if you want to take the rand as your risk barometer, people are saying this is, largely speaking, a good thing. And I guess the interpretation is that this is the first time in 31 years of democracy that the ANC has not been able to simply ram through the budget, kind of like it or not. And I guess there's a dawning realization in the ANC that to get the budget through, because they only have 41% of the votes, they need to bring on board their coalition partners. And I was reading an op-ed by Justice Malala today where he was saying that, really this is in essence a good thing. It forces the ANC to consult with their coalition partners if they want to get the budget through. So at this present moment, there's an element of uncertainty because the budget hasn't been presented, but really it's a sign of a maturing democracy. Obviously, there are aspects to this that are strange and kind of maybe unusual in the sense that the budget was released to journalists at 10 a.m. on Wednesday with the understanding that it would be embargoed until 2 o'clock when the budget speech was read. Now, those journalists have already seen the budget, and notwithstanding the fact that there are kind of confidentialities, elements of the budget have leaked now. So the budget that wasn't read is kind of in the public domain already.
And we've seen that, play out, as you said. We saw some volatility coming through to the rand, some volatility coming through to the JSE as well, but they've both recovered. I want to talk about clothing retailers, and I'll stick with you, Shane. We've got a question that reads, I've noticed that clothing retailers have been under pressure for the past few days. Would you say this is the right time to buy?
So, I think you must separate what is the long-term secular trend, which is largely spending on clothing is getting displaced by other spend like on data and electronic devices, with the short-term trend, which is, what are the short-term interventions that the clothing retailers are doing and what's trade like. I mean, I think trade in November was great, trade in December wasn't that great, and in January it's been slightly better. And that's reflected in the trading updates that the companies have released. The prices of the clothing retailers have declined very meaningfully year to date. I mean, Truworths is down 25% year to date, which is quite extraordinary. TFG is down 20, Mr. Price is down 15 or 20. So, the shares have declined off their highs. I would say that the clothing retailers now are probably worth looking at. If you look at Truist trading at 78 Rand, probably a business that's on like a 8 or 9 PE. And embedded in Truist is a business called Office, which is a UK footwear retailer, and that's doing extremely well. So, the way we would think about Truist is let's put a third of the business, Office, on sort of a 15 to 18 PE, and let's put the SA business, which is 2/3 of the business, on sort of maybe an 8 PE. But if you put, the 1/3 of the business that's growing significantly on a high PE and the balance on 8 PE, you still get a number meaningfully above the current share price. So I think Truist would be our top pick. And I think it's time to start looking at all of the clothing retailers. The reason that they tend to be quite volatile is that they are shares that the foreign investors play in. So, to some degree, the declines we've seen year to date are reflected partly in, slightly subdued trading updates, but also partly reflecting foreigners that have been net sellers of our market year to date.
Interesting that you mentioned that, because then I want to ask Andrew, would you say the short-term dips, or the dip we saw in the retailers, the clothing retailers, maybe this week, was perhaps on the back of the possibility of a hike in VAT? Because that would mean, of course, the South African consumer has less money to spend, less discretionary spending, less purchasing power.
Yeah, I think that's a very fair assumption. But the retailers had a fantastic year last year. There were a lot of things where the stars aligned. We had what happened with in the pension fund space with the two-pot system. We had GNU, so positive sentiment. Load shedding seems to be kind of solved. Interest rates coming down, inflation coming down. So they had a great run last year. I think we're sitting on the fence now and kind of watching them quite closely. Haven't bought any yet. Our preferred retailer is still ShopRite in the food space, but still looking at the clothing space at this point in time.
And looking at those food retailers, it was very interesting to see post some of the information that was leaked from the budget, that the food retailers weren't as hard hit as the clothing retailers. Would you say that maybe perhaps that would have been because there was an assumption that more items would be added onto the zero-rated basket, Shane?
Yeah, I think there was certainly an intensive lobbying by the food retailers to zero-rate further items to protect poor people. The thing about VAT is that VAT is what we call a regressive tax. It affects everyone equally, rich and poor, where normally tax systems are progressive in the sense that wealthier people pay a higher percentage of tax. VAT is a flat tax rate, and so it impacts the poorer population more, which is why there was an attempt to zero-rate it. If that were to be hiked by the 2% that was proposed, that would knock about 0.5% off GDP. What's equivalent, the spend equivalent is about 0.5% of GDP. So it's quite a big number. I mean, there's no doubt that it would affect discretionary spend more than what it would affect food retailers. But having said all that, I think a VAT hike is a dead duck. I think whether it's a good thing or not politically, or rather economically, politically it's dead, right? I just cannot see when they do the budget speech in March that there will be a VAT hike as had been originally planned. So I would say that kind of overhang to some degree is removed. I agree with Andrew that, the food is a lower risk place and ShopRite is clearly an advantaged retailer strategically. But I do think the apparel guys are starting to get into a price range that now looks attractive.
Let's move over to China. The next question is on the Chinese tech rally that initially was sparked by DeepSeek. And we've seen, a number of tech companies announce major AI plans as well. Today, the rally being boosted by Alibaba's results. The viewer is asking if you are seeing value in this space. I'll start off with you, Andrew.
Yeah, so I think we had our morning meeting this morning, and Chinese tech was quite a large discussion. If you look at Alibaba, they're in a forward PE, even with the rally they've had. I think it's a forward PE of 13. They were on a forward PE of probably 8 or 9. Last night, we also had Walmart's results come out, but those results, low sales growth, but they're on a PE of 36 times. So you've got Walmart 36 PE growing at maybe 5% sales, Alibaba growing at 8 on a forward PE of 13. It just shows that the sentiment in China was extremely low. It's still low, not as low as it was a few months ago, but compared to the US where, expectations are quite high. So yeah, China's looking interesting, and it's something I think we need to pay attention to. One of the worries we've had in the last few years is what's going on with government and tech and kind of the relationship there. It's kind of like Jack Ma disappeared for 4 years and lived in a cave in the mountains, but I see now he's back, and he was at the business leaders function that Xi
Having
Jinping
tea with Xi
had.
Jinping.
Yeah, so it looks like the regulatory environment for tech appears to be easing in China, and I think it's worth paying attention.
So that regulatory environment improving, Shane, and it seems like the stimulus measures are starting to work their way through the economy. Is China a market you're looking at, particularly those tech counters?
Look, I mean, almost all markets are driven by, let's say, sentiment and flow. And so, sentiment is undoubtedly improving. I think you've got to bear in mind, though, that Alibaba has rallied from 80 Hong Kong dollars in January to 140 Hong Kong dollars now. So what's that, like a 75% rally in 30 days. So it is cheap, but I think it's pretty evident that to some degree, the easy money's been made here. I mean, of course, if you go back further in time, if you want to take a 5-year view, Alibaba was $300 5 years ago. So, the rally from 75 to 140 doesn't seem that extreme. These are geopolitically driven flows. And if money flows out of the United States into the Chinese market, that could be, you could see even more extreme price movements. I mean, I think I've mentioned this before, but just one US company, NVIDIA, is worth about 30% more than the entire Chinese market. Apple and NVIDIA together are roughly worth what the second biggest market in the world is worth, which is Japan. So we have had extremely crowded trades in the US market, where companies like NVIDIA over the last couple of years are up 800%, and businesses like Alibaba and Baidu and Meituan are up, either single digits or, in the case of Baidu, down. So the Chinese market probably in the long run still has significant upside, but I would feel that just in the short run, it's done quite a lot. I mean, in our domestic market, Naspers and Prosus are both up 25% this month. So, our strategy is to monetize our gains when you have these extreme moves, but I don't discount the fact that these markets can move significantly higher, but over the next 6 or 12 months, not next month.
This is quite a lengthy one. It's on iron ore. It reads, looking at the iron ore prices from Kumba's results, it got me wondering about Afrimat's 2025 full-year results. Bulk commodities accounted for 33% of Afrimat's group operating profit in HY 2025, and services accounted for 49%. Looking into the second half of FY 2025, considering lower iron ore prices and their recent trading update, Afrimat might only break even or slip into the red. Considering the above, is Afrimat still a better investment case? Shane, let's start off with you.
So, look, Afrimat is quite a diversified company. It's about a 10 billion market cap. It's probably on an 11 or 12 PE. It's run by Andres, who I think is quite an inspirational leader and great strategic thinker. So I think Afrimat can belong in your portfolio at any time, just because it kind of ticks the boxes we like. Having said that, they have embarked on 2 new ventures, one in iron ore and one in cement, both of which are a drag on earnings at the present moment. The iron ore price, I think, has done better than what most people think. It's trading at about $106 a ton. It's up, I guess, 5 or 10% over the last 6 months. Notwithstanding what people say about, excess supply and slowing demand for iron ore in China, it really doesn't seem that it easily goes below $100 a ton. So we're bullish on kind of the iron ore plays. And I think Afrimat, you kind of back the management to fix this problem that they have. I think Afrimat is increasingly viewed as a way to play infrastructure in South Africa, and there are not many vehicles that you can play infrastructure. If you go back to the years prior to the Soccer World Cup, we had 4 or 5 very large construction companies. These are either bankrupt or small businesses now. So if you want to play construction, there really is, in South Africa, essentially, there's Afrimat, there's Wilson Bailey, and then there's Raubex. There are 3 ways to play the infrastructure spend if you believe it. Now, President Ramaphosa has been saying they're going to spend 980 billion on infrastructure over the next decade. It's difficult to know whether they will deliver, but were that to happen, there are only a few ways you can play that spending.
With sentiment then improving, Andrew, around the economic recovery in the country and, plans around infrastructure spend in the country, would you be looking at a play like Afrimat?
My short answer is yes. I think if we take a 10-year view, what they've managed to achieve is phenomenal. I think not only have they handsomely crushed the JSE, I think they've actually outperformed the S&P 500 on a 10-year view, total return basis. So hats off to that management team. They've got some short-term temporary headwinds that's, I agree with Shane, that they can solve. They're a fantastic management team. And so, it's definitely one for JSE investors to look at for their portfolio.
Let's move over to Anglo American Platinum. The viewer says those shares are down 28%. Should I just sell and take the loss, or is there a chance of some upside? I mean, they are making progress with the demerger, but those lower PGM prices still weighing on earnings. Would you stick around, Andrew?
Sure, that's a hard question. So how we're playing in the resources space is we've got some exposure to Billiton. That's kind of our first pick, your widely diversified miner, low-cost producer, with a little bit of Anglo Gold for the gold exposure and a bit of Kumba at the moment. The platinum space is not really a place that we've been looking at, so I can't really comment too much there.
All right, with that lower PGM price in play, Shane, would Amplats be something you're looking at?
So interestingly, we've got Craig Miller, the CEO, in our office at 2 o'clock today. So if you ask me in an hour or two's time, I might be better informed. But I think the truth is Amplats, look, they've had 2 problems. They've had low PGM prices, and they've had Anglo-American stuffing the market with Amplats shares. And, we now have the situation where Anglo-American have said they're going to keep 19.9% of the shares back. I find this decision incomprehensible because it doesn't seem to serve the interests of Anglo-American or Amplats, because it creates a further overhang until those shares are placed. Having said all of that, I think that Amandelbult and Mogalakwena, which is their main assets, are good assets. I think the management team of Amplats are good operators. We think that PGMs are probably reaching, the low point in terms of metal prices. Platinum and palladium both trading a little bit below $1,000 a ton. We think that kind of all the headwinds that they've faced, including kind of a migration to EVs, are starting to abate. And I think probably this could be a good entry point in the PGM sector. Share prices are down a lot. Underlying metal prices are down a lot. As I said, some of the headwinds are starting to abate. I mean, you would have seen in the Porsche results, they have severely curtailed their EV initiatives in their new models, the Taycan and the Cayenne. They may not even launch an electric Cayenne. So I think the internal combustion vehicles are going to see a little bit of place in the sun over the next 5 years.
I don't know if anyone looks at Mete. A question just came through that reads, will it be wise to still keep Mete investments as part of my portfolio, Shane?
So Mete export into the United States. Donald Trump has said he's going to tariff the stuff, their product 25 to 50%. It's hard to know how that might play out. I think, the share price has got crushed, right? It was 25 Rand, it's now 5 Rand. So at this point, I would view it as, I wouldn't have a large part of my portfolio in it. But, from here, I think there's sufficient damage that has been done to the share price that you can afford to wait and see. But it's definitely not a pension fund type equity.
Let's move over to Dis-Chem. A question here reads, the viewer's asking for the panel's thoughts on Dis-Chem and how it fares against its competitor Clicks. Andrew, I'll give you that question.
Yeah, sure. So the Dis-Chem results that came out just now, look, they're growing revenue. I think revenue was up 7%. But not good against expectations, in my opinion. They're on a PE of 28, growing at 7% revenue. I think that's a bit low. If we compare like for like, I think Clicks is growing a bit faster than that. Also, Dis-Chem is accelerating their store expansion project. So I thought, with that going on, we would have had more than 7% revenue growth. So for me, that was a little bit disappointing. Look, it's a stock we watch, but we're not climbing in.
What about you, Shane? Are you seeing value in Dis-Chem at the moment?
So Dis-Chem and Clicks have a slightly different operating model. Clicks has more stores, and the stores are smaller. Let's say the average Click store is maybe 750 square meters. The average Dis-Chem store is probably double that, 1,500 square meters. I would say that they differ in the sense that Dis-Chem is very much a destination shop and Clicks is more of a convenience shop.
Yeah.
I think the shopping experience at Clicks is very much better. I think if you look at how the stores are laid out and the shop fittings, Clicks is a higher end, more female-friendly experience. Dis-Chem feels like a slightly more industrial experience. So I think Clicks is executing better on a model that is slightly simpler, and we're not buyers of Dis-Chem. I think Clicks is expensive, but it's a very good company.
Yeah, I never thought of it like that. Interesting take, Shane. Let's get to your stock picks. I will start off with you, Shane.
So I was punting Sasol the other day in the 70s. The shares bounced into the 80s, and I'll continue to punt Sasol. I would say there are three reasons, and the one is a recently emerging reason, and that is that in the budget, which was given to journalists, leaked, and then not read, there was an announcement to postpone the carbon tax that Sasol would have had to pay. And this is obviously an environmental legislation that was coming, but it was going to be very expensive for Sasol. It was going to cost them between 3.5 and 7 billion. This is now delayed. And that is one of the reasons why the Sasol share price has bounced up from late 70s into the mid 80s. I think the other reason to be bullish Sasol, as I said previously, is that I think Simon Baloyi is a good chief executive, and I think he's at last trying to extract value from these assets. And if they were to sell Lake Charles, that could easily be 50% of the Sasol's market cap right there. I think results on Monday, and we'll know more after that.
All right, so Sasol for Shane. What are you going for, Andrew?
Darling, my pick is Alphabet. So I think US markets are a bit stretched at the moment, but on a forward PE basis, Alphabet's on 20, which I don't think is excessive compared to the rest of the S&P 500. They've got a very strong balance sheet. And lots of businesses under the hood there that are phenomenal. If we look at YouTube just as a standalone business, revenue is about $50 to $55 billion. That's more than Netflix. So I think they're a phenomenal business, not excessively priced, strong balance sheet, great businesses under the hood. And that's why they're my stock pick today.
All right, so Alphabet and Sasfin, gents, thanks so much for joining me this afternoon. Thanks to my guests, Andrew Padoa from Sasfin Wealth and Shane Watkins from All Weather Capital. Remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming through. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.